All right, Chapter 6, Question 18A. So in this question, we've got a company called Fraser Consulting that after the first month of operations, it's showing the following unadjusted trial balance details. Adjusting entries have not yet been made. So we were asked to use this trial balance and the information below from these 5 bullet points for the month of September to complete this 10-column worksheet. I will walk through these transactions in a moment. All right, so I've set up this spreadsheet, or worksheet I should say, in Excel for this exercise. I've included the adjusted trial balance figures as per the problem provided, and now we need to walk through the various adjustments. First adjustment says it was determined that $1,500 of the prepaid rent had been used during August. So in this situation, we know we need to adjust our prepaid rent, and we need to adjust our rent expense for that said period. We will credit our prepaid rent to reduce the value of that account and debit our rent expense to increase the expense incurred by the organization. The next step says depreciation on the automobile for the month was $1,000. So we'll have accumulated depreciation and we'll have depreciation expense for that said automobile. And again, it's a credit to accumulated depreciation to increase the value of that contra account to our automobile. And it's a debit to the depreciation expense for the auto to increase the value of the depreciation expense account. The next item says salaries of $1,200 had been incurred but not yet paid. We haven't paid it yet, so we're setting up a liability, salaries payable, and we need to record the salaries expense. So in this situation, we've got $1,200 as a debit to salaries expense because we're increasing the expense in the organization. And we've got a $1,200 credit to salaries payable because we will pay it next month. The next item says $1,500 of the unearned revenue is earned during the month. So we have unearned revenue and service revenue that need to be adjusted for $1,500. We want to increase our service revenue, so it's a credit to our revenue account to increase that account. And it's a debit to the unearned revenue to reduce that liability account for the organization. Lastly, the interest of $600 in the bank loan had been incurred but not yet been paid. So in this situation, we have our interest expense and interest payable that we need to record. Our interest payable is a credit for $600 because it's a future liability. And we have an interest expense. We need to debit it to increase the value of our expense. Once we've done those entries, we then want to add up the relative columns to make sure that our debit and credit adjustment columns are in balance. Once we've verified that these items are in balance, we will then move forward and create our adjusted trial balance. In this situation, we need to take our opening unadjusted, plus or minus any adjustments. Okay, again, as mentioned in class, you want to make sure that the debits plus debits are added to the debit, and debit minus a credit would equal your new debit balance if the debit exceeded the credit. So be very careful of your formulas here. So in this situation, I've got a revised adjusted trial balance with a debit and credit column now totaling $111,800. The next step of this worksheet is to identify what should be included in the income statement versus the balance sheet columns. So on the income statement, it should be everything from revenue and expenses and below. So we'll pull over the service revenue and expenses to those columns, and you'll notice that our credits exceed our debits, which means we have a net income required in order to balance those columns of $26,700, which if you were to create an income statement, you would get that number as well. The next item is to calculate your balance sheet. Our balance sheet then would be all your assets, your liabilities, and your equity accounts. So now we have a total variance in those balance sheet accounts again of the $26,700, which happens to be your net income, which means we've generated income, which means we will add that to our statement of owner's equity. So our capital account, once we've posted those closing entries, will increase by that same amount. So now we've got a balance on our balance sheet of $101,000 of both sides. I hope you found this helpful.